episode of Smart Money Millionaire. My name's West Cohan, Certified Financial Planner, and today we want to talk about how to invest and protect your portfolio in a down market. So as of April 2020, the markets are in complete turmoil, caused largely by the coronavirus COVID-19, collapsing energy prices, and the unprecedented response by central banks and federal governments around the world. Now, we know it's a challenging time to be an investor in these sorts of markets. In fact, the markets dropped over 30% this year in less than a month. Now, this is leading many of our newer clients to ask me questions like, West, will the markets drop further? Or, is my portfolio safe? Or, do you think we should sell everything and get out before it drops any further? Or, do you love me? Have I made you proud yet, Father? Okay, well maybe not that last question, but the other ones I've been hearing a lot. It's easy to be an investor when everything is making money. Last year in 2019, it was super easy. There was double-digit returns as far as the eye could see in just about every asset class. I bet even your brain-dead, lazy coworker made over 20% in their 401k. Nice. But right now, with the markets where they are, it's a completely different ballgame. So we wanted to take some time today to talk about the mindset and psychology you need to be successful in a down market, as well as some tactical tips and moves you can make to take advantage of this opportunity. So let's jump into the psychology side first. As many long-term investors know, investing is a surprisingly mental exercise. So let's get that big brain of yours pumped up with some investing knowledge. We want to talk about 3 psychological points today. The first point is that you need to have realistic expectations, specifically about your annual gains and losses in your portfolio. Long-term growth is created through messy market cycles that ebb and flow. You should fully expect to have a bad month, a bad year, or sometimes even a bad few years from time to time. It's kind of like baseball. You don't need to bat 1,000 to be a successful baseball player, and you don't need to make money 24/7 as an investor to be a successful long-term investor. And so if somebody's telling you that their portfolio is always making money and they never have a downturn and every single trade they make is profitable, well, there's probably something fishy there. And if we were comparing this to the game of baseball, I would say that portfolio might be on some Barry Bonds or some Mark McGwire level of steroids, because that's just a little bit fishy. Now, it's very important psychologically to be anticipating and expecting downturns ahead of time. That way, when they finally come, they won't catch you by surprise and you'll be prepared to deal with them. The second psychological point we wanted to talk about today is sticking to the script. Now, when we say stick to the script, we mean you should stay in line with your long-term investment philosophy and your long-term and disciplined investment strategy. So if you don't have a long-term philosophy and strategy already in place, that's probably one of the reasons that you're feeling lost or anxious in this down market. A truly comprehensive strategy is designed to withstand the test of time, including market downturns. So if you're a moderate, long-term, buy and hold value investor, and you're still 15 years away from retirement, and your strategy says you should own a large chunk of stocks in your portfolio, and the market drops 30% like it did this year, you should still own a large chunk of stocks in your portfolio. That's what we mean by stick to the script. You don't bail on your dog and kick your dog out of the house when it poops on the living room floor, and you shouldn't bail on your portfolio when the market poops on your 401k. If you don't have a philosophy or long-term strategy, you should definitely get one, and we'll leave some resources in the description below that will help you flesh that out. The third psychological point we wanted to talk about today is trust the process. So a little data here that we think will be helpful. When you're thinking about the stock market and the long-term historical averages, keep in mind that in a given 10-year period, 7 of those years will be positive and 3 of those years will be negative. And that's been true going back for decades. You don't have to look far to know this is true. If you look at the S&P 500 from 2009 to 2019, 11 years, you'll note that 10 of those years were positive and only 1 of those years were negative. So it's super important that you understand there will be winning years and losing years. A long-term investment strategy is profitable because over the long run, the good years will outweigh the bad. At least that's what I tell my wife. Right, honey? By now, you should be feeling a little more bold and ready to make some smart money moves. So let's talk about some tactical moves you can make in your portfolio. The first tactical move we want to talk about today is when in doubt, you should probably do nothing. And by do nothing, we mean stay the course, don't buy, don't sell, just leave your portfolio where it is. Remember, the number one mistake that investors make is panicking and selling when the market drops. You do not want to do that because then you're locking in your gains at the bottom, you'll likely miss the recovery, and you'll be stuck chasing it. Completely normal and okay to be in touch with your feelings and to know that it doesn't feel good watching your portfolio drop. It does not feel good watching the market crater and watching your investment accounts go down. You should be feeling a little anxious and upset, kind of like when you crave a Chick-fil-A sandwich and you realize it's Sunday. Resist the temptation to panic sell. If you own quality assets, and you should own quality assets, they will survive the downturn. If you don't own quality assets, then it might be time to start selling your penny stocks on Craigslist. The second tactical move is to deploy cash and buy what's beat up in line with your long-term strategy. If you have cash in your portfolio, or maybe you have lazy money in the bank above and beyond a rainy day fund. Now, a lot of investors refer to this as running into the burning building, or trying to catch a falling knife, or buying when there's blood in the streets. When the markets are down 20%, I like to think of it as going to the store and getting 20% off on your purchase. Getting 20% off or even 10% off is a great discount for a long-term investor. Investment gurus love to give the advice, buy low and sell high. And that's great advice in theory, but those gurus often leave out that this is what buying low feels like. It can be very challenging and difficult to actually pull the trigger and make a buy when there's this level of fear and uncertainty in the markets. But you should absolutely be looking to remove the emotion from your portfolio and your decision-making process and see if these sorts of moves make sense for you. What's that? Did you hear that? That's the little voice in the back of your mind saying, but what if I buy and then the market drops further? Well, that's certainly a risk, but for a long-term investor, you really need to look within, dig deep into the depths of your soul, and ask yourself, do you have what it takes to look fear in the eyes and make some buys? For those of you that would like to make some buys but are feeling extra cautious, consider dollar cost averaging into your positions over a period of time. That's a great way to further remove emotion from the process and reduce volatility on the purchases that you're making. We'll leave a link in the description below with some more information on dollar cost averaging. Third tactical move we wanted to talk about is repositioning assets tax efficiently. So before we jump into this, please keep in mind that these are more nuanced moves that are really going to depend on a case-by-case basis and are really designed more for intermediate to advanced investors. That being said, there are opportunities in a market downturn to reposition assets for better gain and for tax efficiency. So for example, let's imagine you have a $100,000 portfolio, and let's say you have $80,000 of stocks and $20,000 of bonds. Let's imagine that your stock position is down 20% and your bond chunk is up 3%. And that's not unusual in a market like this. So one move to consider repositioning wise would be to sell your bonds that are at a profit or close to break even and rotate over and use those dollars to buy stocks that are beat up and trading at a discount. So keep in mind, these moves are really designed just to be used around the edges of your long-term strategy. You should only be looking to reposition maybe 10 to 20% of your entire portfolio. This is not the time you want to start trying to liquidate your entire portfolio and completely reposition it. That's not what we're talking about here. We're talking about making smaller opportunistic moves around the edges with 10 to 20% of your portfolio. So if you have a $100,000 portfolio and $20,000 in bonds, you might want to consider rotating or repositioning 5,000 or 10,000 of that bond position. Another idea to think about in these down markets is tax harvesting for tax efficiency. So if you have a non-qualified or non-retirement account and you've been building up a lot of unrealized long-term capital gains in that portfolio, well, now could be a great time to start selling some of your positions that are in a net loss position, and that will create tax harvesting opportunities to offset the gains from some of your other positions. And if you are going to reposition assets in your portfolio, make sure that you're rebalancing every year or two, just to make sure that you're realigning with exactly where you want to be in terms of your long-term strategy. So we've talked about how to get your head right. We've talked about a few tactical moves that you could make. What should you be doing right now with your portfolio? Number one, you want to make sure that you have your head right and that you have a well thought out investment philosophy and investment strategy. That's going to be super important to making sure that you can handle whatever the market throws your way. Number two, you should be looking at your investment accounts, even though it can be scary. You want to see what's going on there, and if there's opportunity to buy things at a discount, maybe reposition or make some tax harvesting for tax efficiency, or maybe you don't need to do anything and you should just hold, but it's still good to know that. So take a look at your portfolios and see what sort of moves might make sense for you. Another note, for new investors who might not be in the market yet, now is a great time to actually start investing. While it can be really challenging and difficult emotionally, you're going to learn a lot by investing in these types of markets, and also you'll be able to begin building excellent long-term positions and buying them at discount bargain prices. Above all else, and this applies whether you're doing it yourself or you've hired an advisor, don't let your emotions get the best of you. It's not easy, but it is super, super important. Quick disclaimer, while I am a licensed financial advisor, I am not your financial advisor. This video is intended for educational purposes and should not be used as the basis for making trades. Every portfolio is different, every client situation is different. The tax rules and regulations might vary by jurisdiction. That being said, we hope you found this video helpful. If you do have specific questions about your portfolio, please feel free to leave them in the comments below. Would also greatly appreciate if you would like, comment, share, or subscribe. It's been an absolute pleasure making this video for you here today. Thank you for watching. I really do appreciate it. And remember, if you're smart with your money and you make good decisions, you're on your way to becoming a smart money millionaire.